We have revised our forecast, and this revision includes a substantial but not entirely surprising downgrade to our estimate of world merchandise trade growth this year, lowering it to 0.8% from 1.7% in our April forecast. Several factors combined to dampen trade growth in the first half of 2023. These include persistent inflation and high interest rates in advanced economies such as the United States and the EU, a weaker than expected rebound from the COVID-19 pandemic in China, and continuing aftershocks from the war in Ukraine. The outlook for 2024 has not been downgraded and remains relatively strong. We anticipate a rebound in the volume of merchandise trade, projecting a growth rate of 3.3%, slightly higher than our previous estimate of 3.2%. This growth should be driven by increased trade in goods closely linked to the business cycle, such as machinery and consumer durables, which tend to rebound when economic growth stabilizes. One interesting statistic is the share of intermediate goods in world trade, which provides an indication of the health and extent of global supply chains. This share fell to 48.5% in the first half of 2023, compared to an average of 51.0% over the previous 3 years. This suggests that supply chains might be contracting, but it could also simply reflect higher commodity prices. While we see first signs of fragmentation, there's still no evidence of any broad-based deglobalization.
There has been some concern that slower Chinese growth might weigh down world trade through weaker import demand. This might happen if China's economic slowdown worsens, but so far this has not been the case. China actually contributed 0.3 percentage points to trade volume growth in the first half of 2023, while the US and EU respectively subtracted 0.6 and 0.5 percentage points. Trade in manufacturers overall is down 4%, while services is providing some lift to global trade. It was up 9% in the first quarter.